This is Money Talk 1310 and 100.9. Welcome to the Real Estate PB&J Hour, hosted by Realtors Paul Fuqua and Joyce Carcaise, who are experts in the fundamentals of buying and selling homes and other real estate properties. Now, here's Paul and Joyce.
Well, it's March 24th, and welcome to the Real Estate PB&J Hour. PB&J standing for Paul, Business, and Joyce, and or Peanut Butter and Jelly. Nothing more fundamental than those two terms. And we are coming to you on 1310 AM, Money Talk 1310 AM, and 100.9 FM. You can also go to your computer, turn it on, and crank up moneytalk1310.com and listen to us live. I don't know how you'd hear us if you're not on the radio or not on the computer to do that, but nevertheless, we still give you those instructions. And if you want to follow up on anything you've heard or heard about on this show, you can go to YouTube and do a search on the Real Estate PB&J Hour, and you'll find every one of our shows there for your listening enjoyment. There's a still photo of me and Joyce. She chose it because she's better looking than I am. I look like somebody has just hit me in the middle of the back. But the whole reason for this show is to try and bring to you information of the fundamentals on real estate, the things to do, the things not to do, the things that we know if you do will have consequences. All things have consequences. And real estate, they can be severely damaging to a number of things, your pocketbook, your credibility, and to your happy home life. If you have a question, call us 757-497-1310, 757-497-1310. Now, one of the features of this show is a market update. Joyce, it's up to you.
Thank you, Paul. Excuse me. So not a lot of changes here. Monthly listings on the MLS continue to be historically low, with an average of 2,500 homes listed monthly and an absorption rate of under 30 days, meaning that they are being sold within that time frame. On any given day,
actually, that absorption rate is not the average sale price or sale time. It's how long it would take to close out all of the houses that are on the market if no new houses came on. So if in 30 days at the current rate of sale, every house that's listed would be gone and there'd be zero. Now, quickly, we heard about Northern Virginia.
Yeah, Northern Virginia is crazy.
Give that stat real quick, because that's...
So this is crazy. This is my old stomping grounds, right? Millions of homes up there. We were talking about how many homes are available today, how many active listings, and there are 900. 900.
That's in Alexandria, Fairfax County.
Fairfax County, Falls Church, Vienna, Herndon, and Clifton.
That's why 95 is so crowded. All the people are moving down here because they can find a house.
I know, but that's unbelievable. And the median price up there as well is $607,000.
That's median. Now remember, not average, median. Mm-hmm. That's halfway point. Half the houses are above it, half the houses are below it. All right. I'm sorry. Keep on going.
No. That's okay. Thanks for the clarification on that. On the south side, we're seeing an average sold sales price of about $227,000 in Portsmouth to a high of $380,000, almost $381,000 in Virginia Beach. On the peninsula, we're seeing an average sold price in Hampton at about $233,500 to $470,000 in Williamsburg. Regardless of the location, though, homes are on the market for a median of about 15 days. That's both south side and the peninsula.
Do we have any stats on northeastern North Carolina? Because their specs.
They're still, I think it's about 427, 437, 437.
If you haven't driven down,
and those are new builds.
Driven down to the Outer Banks recently, down 168, you'll see all this new construction that's going on.
Moyock.
Yep, because it's a lot easier to process that development through the permitting and zoning than it is here. I'm sorry. Go ahead.
That's okay.
Back to you.
That's okay. So we always like to hit on some headlines from around the country as well. Puts our market into perspective. So CNBC had a headline, 87.5 million buyers are priced out of the market. So according to a new study, and this is from the National Association of Home Builders and reported by the National Association of Realtors, 87.5 million buyers are priced out of the market today. So if prices rise by just $1,000, an additional 117,932 people would be priced out.
Is that new home sales or resale, or is that just across the board? That's got to be new home sales.
Yeah. No, this is new homes. It's the National Association of Home Builders that released that. So higher home prices, obviously, we have the highest inflation in 40 years, and we also have an incredible demand for these homes by the millennials.
By the millennials and people who are relocating. Texas is a boom. Florida is a boom. Low tax states are seeing huge influx of people from high tax states. And we also, because of we being a military-centered economy, have had an innumerable number of people who have spent time in Hampton Roads and favorably, and they've come back to retire here or to pursue their second or third career. What about Yahoo Finance? What do they say?
So
I like that word Yahoo. That's just that's been thrown at me many times. You Yahoo. That's my wife talking. Go ahead.
So one of their headlines today was that U.S. new home sales drop further as mortgage rates rise. And I've seen this headline everywhere, of course. Prices push higher despite the second straight monthly decline reported by the Commerce Department. And sales remained above their pre-pandemic level.
That's new home sales.
That's resales. That's resale. Mm-hmm.
Oh, okay.
Yep.
All right.
Yep. And obviously, this is a supply and demand imbalance. Mortgage rates as a share of median family income have risen above 20% for the first time since late 2007. This is according to senior property economist at Capital Economics in New York. And that will act to cool the housing market activity. That's what they're hoping. It's going to cool the activity. But a record low number of existing homes on the market, that implies new sales will grind out a small gain over 2022.
These statistics are almost at odds with one another. There's declining inventory. There's still a growing demand, yet they're predicting that the demand will soften. It doesn't make sense. In my mind, when you don't have enough of something and there is demand for that something, the prices will naturally go up. The financing is having an impact. I think people are setting their sights a little lower than they were a year ago because of the impact of increased interest rates. But in my career, I've never seen a person who was prepared to buy a house who was reluctant to do so because of an interest rate rise of a point, unless he was very close to the margin of not being able to afford it on a monthly basis. And I know there are any number of lenders who say to follow the monthly the monthly cost, more closely than to worry about the actual dollar amount or rate of the interest. Because interest is something that you can bandy about in the papers and talk about on the radio and over your cocktails at a reception or a cocktail party or at the corner bar, but it doesn't change the fact that if you are going to spend $2,000 a month for your housing, you may buy a house that might be $20,000 less, but you're still going to end up buying a house because you still want to be able to house your family and have a yard and let the dogs go out and poop in it in the back that you then have to clean up, like in my house. We're coming up on a break, are we? Well, how long have we got, Dino? We got 2 minutes. All right, so Joyce, you got 2 minutes, and then we can say goodbye to our folks.
Yeah, no, I think, but to your point, when was the last time that you saw home sales prices jump 20% and anticipating to jump 22% this year? That's a Zillow estimate right there. When was the last time that you saw that? So when
the early 2000s, where it was more than that. It was as much as 30 to 40%. We were seeing 50% jumps within 3 months, and it was incredible.
And inventory that slim.
Inventory, no, that was that time way back then. Those numbers and those sales were superheated because of the availability of money. Money was easy. Signature-only loans, all kinds of crazy financing packages. And there was also opening the floodgates to an underpinning of people who really were not capable and competent enough because of their personal financial structure to afford to buy a house. But they bought them.
Predatory lending.
Yeah, exactly. We talked with Cliff Hayes about that last week. All right. You do the sign off for the break.
Okay. You're listening to the Real Estate PB&J Hour on 1310 AM, 100.9 FM, or on the web at moneytalk1310.com. When we return from the break, we'll be talking interest rates and more with Greg Bell, mortgage broker with Dolfin Home Loans. We'll be right back.
Welcome back to the Real Estate PB&J Hour on Money Talk 1310 and 100.9. Rose and Womble Realtors, Paul Fuqua and Joyce Carcaise continue their discussion of the fundamentals of home buying and selling.
Welcome back. We're here with Greg Bell, mortgage broker with Dolfin Home Loans. Greg, welcome back as well.
Thank you, Joyce. Really thankful to have you.
You know,
my question to you is, it's important. How is business? What are people doing when they come into your office or they sit down with you in their kitchen and talk about setting up the process to be prepared to buy a house?
Well, I think you nailed it earlier. Business is not slowing down. Demand for new purchases, whether it be resale or new construction, is at an all-time high. Applications are up. I know nationally applications are down, but it's a little skewed because that takes into account the refinance applications, which have completely fallen off. Outside of your occasional cash out refinance that we're still doing here and there, it is all purchase right now. But demand, people still want houses.
Well, with the increasing value, why are people not refining? Because is it a consequence of rates falling off?
Well, rates are definitely up. We're seeing in most agency products 1.5 to 2 points higher than we were 6 months ago. So you got two main types of refinances: your rate and term, which is basically just that. You're lowering your interest rate to lower your payment. And then you have your cash out refinances. So we are seeing cash out refinances because even with a higher interest rate than we were last year, people are able to tap a tremendous amount of equity. Right now, U.S. is sitting on the most equity that we've ever had in the history of housing.
We talked about that and the distribution of wealth last week and the week prior. When you talk about cash out financing, explain to me what that means. I mean, I have an idea that I own this house and I've got all this equity. Now I'm going to take it out, but I'm still going to have to pay it back, right? It's not like a reverse.
No, you're absolutely right. You still got to pay it back. So your biggest option, let's say someone bought a house for $200,000 2 years ago. Well, that house could very well be worth $300,000 now. So you're sitting on 30% equity of the house. Now, depending on what loan product you look at, VA will allow you to tap 100% of that equity. So let's say you were VA and now the value of your home is $300,000. You can get a new 30-year fixed loan for $300,000, and at the closing table, you're going to get a check for $100,000. Now, those are basic numbers, but that kind of gives you an idea. Another way that you can tap your money is with a HELOC, a home equity line of credit. It is a bank product. You would keep the terms of your first loan, and you would go and get a home equity line for the equity that you have in your house. And it allows you to tap it almost like a checking account. You only pay for it as you use it.
Would you advise that? For instance, in my wife and I, we've always tried to pay cash whenever we've done renovations to the house. And in this instance, I want to do a big fell swoop, a great big new driveway and new fencing, and she has a bathroom she wants to do. Would a HELOC be advisable in my situation, or do I don't want to refi because I haven't been in the house that long?
So what I would say is if you took advantage of the low interest rate over the last 2 years, then a HELOC or a home equity loan would be the better bet because you're not restarting terms. You're not going to take a higher interest rate. That first loan stays still. Your HELOC or home equity line would be just a second mortgage that you're going to pay, and oftentimes you can pay interest only, but of course we would advise to add some principal to that. But the HELOC's interest rates are going to be a lot smaller than a personal line of credit or a credit card. So you could be in the 4 to 6% on a HELOC or use your credit card at 22%. So I would highly suggest using a HELOC over any type of other revolving credit.
Do you want to touch on what the rates are? Basically, in conversation you've had that, but right now, can you tell me what you were quoted this morning?
Well, as you know, Paul, there are many loan options, products, and things that go into interest rates. But yes, if we look at the three main loans that we deal with on a daily basis, VA, FHA, and in your agency, or your Fannie Mae, Freddie Mac, your conventional loans, they are about 1.5 to 2 points higher than we were sitting at about 4 or 5 months ago. So conventional is about mid-4s, VA's high 3s, low 4s, depending on credit score, and what we find is FHA tends to follow VA. So again, right there at that low 4 range.
Now, we're going to be talking with Mike Vernon later in the show about flood insurance and mitigating the conditions at the house so that flood insurance the expense can be lessened. If you have someone coming in and they're looking for something that may well be impacted by flood insurance, how do you make a determination about a property and the impact of that property's required insurance on their ability to repay? Did I make it that too complicated?
I think I've got your question.
Okay.
So flood insurance, just like your homeowner's insurance, is factored into your debt to income ratio when you qualify for a loan. So if you are looking at a property that's going to need flood insurance, it's going to be advised that you go and get a flood quote up front to make sure that you qualify. So if you are at the top end of your debt to income ratio while you're shopping for a house and you find something with flood insurance or homeowner's insurance, these are all items that factor into your payment, which then in turn factor into your debt to income ratio. So you're going to want to make sure that those figures work for you, work for your loan, and figure that up front before you go and place an offer.
Okay. Debt to income. What's the percentage? If I've got 40% of my monthly is already accounted for or will be accounted for with the purchase of this house and a car loan and whatever else I have, what's the percentage that I have to get a good loan?
Okay, so when we look at your debt to income ratio, what we do is we use your gross monthly income. That's before taxes and everything else is taken out. Then we look at your minimum monthly payments on your debt. So we don't care too much about the balances on your credit card, how much you owe on your car loan. We look at the minimum monthly payments. So we add up those minimum monthly payments plus the projected housing payment, and that's the back end ratio of your DTI, your debt to income ratio. So on conventional, we have to stay below 50%. Now we're assuming 700 plus credit. When the credit scores get a little bit lower, it gets a little bit tighter, but let's just assume 700 plus. We got to stay below 50%. FHA and VA actually doesn't have a debt to income ratio limit. So we can do 58, 65. I mean, I've done as high as 68% debt to income if there were compensating factors there. But in general, what we like to see is somewhere around the low 40s to be ideal.
Okay.
Well, do you have anything to ask?
You asked all my questions.
I did.
You asked all my questions.
How did you let me do that?
You can. We won't go there. You had a good flow. I think actually I do have one question. What are you seeing, like when you're processing the loans? What price points are you looking at? What are you seeing coming across your desk?
So it's interesting. When you look at the average loan size that I've had from 2018 till today, 2018, we probably saw average of about 260 to 270. Mm-hmm. Last year, 2021, I finished off at about 340,000. So that's 160 transactions with an average loan amount of 340. So that's a pretty significant increase in such a short time. I'll be honest, I mean, and you guys see it a lot in this 5, 6, I mean, even up to 800,000, this market is hot. I mean, it's nothing to have 15 plus offers on $1 million house right now. And we're seeing a lot of that.
Interesting enough, I have a client who asked me to look in a specific area within a 2-mile radius of a center point of his interests. And I said, well, what kind of price range you're at? He said, I've been $1 million and down. I really don't want to spend that, but I can afford it. And I did the search today, and I didn't find one house, not one house in an area where you would see normally 15 or 20 at the high 9s or 8s, and some of them bumping over $1 million. And he's got a house. He wants to move, and he's got a house that is going to go on the market at $1 million, but he can't sell it because he doesn't have any place to go.
Where's he going to go?
Yeah, that's it. Well, is there an advantage to somebody, Greg, who is coming into this area flush with cash? Would you advise him to carry a small mortgage just to make certain that the standard monthly payments are made and for ease? I mean, I've always advised people who've just sold their house in New Jersey and they're flush with cash and they're going to buy a house and we'll pay cash. And I said, well, why? So what would you advise people to do?
Well, everybody's situation is unique. I tend to follow your advice there too. I've always gone with cash is king. If you can afford the monthly payment, let's keep some of that cash behind. Especially in this market, it's good to have that cash for a guarantee because, as we're seeing, I mean, many people are offering $40,000, $50,000, sometimes up north of $100,000 over asking price just to win the deal. So instead of dumping all that into the loan up front, hold on to some of it because you may need it on the back end.
And Greg, I think, we were talking earlier about the differences between where we are today in the market and where we were in 2008. Can you give a little of your overview, what the difference is?
Yeah, I hear this a lot that, from people who aren't in the industry, they're afraid of the next crash. When's it going to happen? This feels like 2008 or early 2000s. And the biggest difference between now and then is how tight the mortgage industry is. It is not easy to get a loan right now. You have to have good credit. You have to have money. As Paul mentioned earlier in the show, you can just sign a piece of paper. There was stated income loans back then. It's nothing like that. We're seeing a lot of non-QM or non-qualified mortgage products come back, but even those are nothing like we saw in 2000s. You still have to have 10, 15, 20% down, good credit, good job. It's just not something that I think that we're going to see. And when you listen to a lot of economists across the country, that's just not where we are. Inventory is just low. There's several factors behind it. A lot of cash, big money coming in, buying properties and turning them into rentals. People holding on to departing residences because they have such a low interest rate that they can rent it out and make good money, so why sell it? So all of these factors are contributing to our low inventory right now.
Dino has given me the high sign. It's time for us to break. This is Paul Fuqua and Joyce Carcaise with Rose and Womble. You're listening to the Real Estate PB&J Hour. 1310 AM and 100.9 FM on Money Talk. We'll see you in a few minutes with Mike Vernon talking specifics about flood insurance. Listen up.
Welcome back to the Real Estate PB&J Hour on Money Talk 1310 and 100.9. Rose and Womble Realtors, Paul Fuqua and Joyce Carcaise continue their discussion of the fundamentals of home buying and selling.
This is Joyce with Paul Fuqua. Welcome back. For this segment, we're going to talk about flooding in FEMA. As you all know, flooding is synonymous with Hampton Roads. Swamps, the ocean, the bay, rivers, and other tributaries define our geography. Flooding, rising sea levels, and sinking land masses are some of the things that the cities in the state are trying to deal with in planning and present and future action. Home buyers in flood zones are required by their lenders to have flood insurance, as we know, and we always recommend that even if you aren't in a flood zone, you may want to consider that whenever you are financing your home. We have Michael Vernon here, CEO of Flood Insurance Hampton Roads, to talk about FEMA 2.0 and, potentially flooding mitigation, pros and cons. Welcome, Mike.
Thank you very much, Joyce. I appreciate it.
Now, I'm going to jump in because we have a caller if Dino's given me the word. Kim, this is Paul Fuqua. Welcome to the show.
Thank you.
Tell me, go ahead and pose your question because we've got an expert here.
Okay. Sounds good. I was just curious as far as if you're not in a flood zone, why is it important to have the flood insurance? And I understand that some circumstances can always change, but if you could just give me some pointers as to why it would be a good idea.
All right. I'm sorry, you said your name was Kim?
Yes.
Kim. Number of things. Let's clear up the verbiage real quick. Every house is in a flood zone. It's just that some houses are in what's called a high-risk flood zone. And if you're located in one of those flood zones and you have a federally backed mortgage, you're required by law to carry flood insurance. If you do not live in a high-risk flood zone, you live in what we refer to as a voluntary zone. On the map, it's the letter X. And what that means is that you're not required to carry flood insurance, and if you wanted a flood insurance policy, it would be completely voluntary. Now, Old Dominion University did a study not too long ago, and they said if we get hit by a Cat 2 hurricane, we're all going to be in canoes. So even though I don't live in a high-risk flood zone, I carry flood insurance, and it's a voluntary policy. So everybody has their own preference for risk, and some people can go to bed at night with the windows open and the doors unlocked, and if you're like my wife, you're going to lock everything down and turn on all the outside lights. So depending on what your risk preference is, I think it's very wise to carry flood insurance in Hampton Roads unless your house is on top of Mount Trashmore. So that's just my opinion, and it's based on the fact that when Hurricane Harvey hit Houston, 80% of the houses that were destroyed were not in a high-risk flood zone.
Oh, okay.
Anything else you'd like to ask him while you're here? This is Mike Vernon. He is the area's leading expert on flood insurance and mitigation procedures and processes.
Well, that was a good point that you made. I didn't realize that, you consider everybody in a flood zone. So that was a good point for me to hear. And I guess
these hurricanes and tropical or nor'easters and the type of storms that we get flooding with, they don't know where these lines start and stop on the flood maps. They're going to go where they go, and so therefore, I think that in Hampton Roads, which is one of the lowest areas in the United States, and we have sinking land mass, we have rising sea levels. These storms are bigger and stronger. They cover larger geographical areas. We've set all kinds of records in the last few years. Michael went from a Cat 1 to a Cat 5 faster than any other hurricane. We had Irma maintain its Cat 5 status longer than any other hurricane. Harvey dropped more rain than any hurricane's ever dropped. So to me, it's one of those things that if you want flood insurance and you feel safer with it, you should get it. But don't just keep it for a year. I mean, that way you're just playing roulette. If you're going to keep it, plan on keeping it long term.
Right. Okay. Yeah, those are good points. I appreciate that.
Thank you very much for calling, Kim.
Thanks, Kim.
Thank you.
We appreciate it. Mike, you touched upon a number of things. The one is my understanding that there's been a significant change in how the federal government through FEMA offers the coverages throughout the United States, and that it's causing some grief in your industry. Can you elaborate on that for our audience? Sure.
So the National Flood Insurance Program is managed by FEMA, and FEMA is managed by the Department of Homeland Security. The National Flood Insurance Program covers about 98% of all residential properties in the United States. If you the other part that's covering these houses is what we call private sector. Private sector is the normal insurance industry. And as FEMA's rates or the National Flood Insurance Program's rates have gone up, these private sector companies have seen the opportunity for profit, and they're starting to emerge in the industry. Still very small percentage, but it is a growing sector. The National Flood Insurance Program, which is $25 billion in the hole, has gone through a process of redoing its pricing algorithm, trying to make up that large debt. And what they're calling it is Risk Rating 2.0. Risk Rating 2.0 went into effect October 1st of last year. Anybody who has bought a brand new policy since October 1st has bought it in Risk Rating 2.0. People who had existing policies, once they renew after April 1st, in just a few days, they're going to renew on Risk Rating 2.0. And Risk Rating 2.0 has an algorithm that's in a little secret black box. We know what's in the algorithm, but we don't know how the algorithm is weighted. So we're all going through a learning process on how 2.0 is affecting everything from the real estate market to homeowners who are seeing their rates change sometimes rather dramatically.
Now I have a question. I live in Norfolk in a waterfront community. I'm not on the water. I'm across the street from it. It's in my neighbor's backyard. He can have that. It's nice to look at, but he's in the flood zone. I'm not in the flood zone, but I'm in the evacuation zone. Does that mean when I go and I carry the minimal flood insurance. But am I going to get hammered when and if I go to renew this coming year?
Well, the sad thing is I could tell you the answer. Now I don't really know. And again, you are in a flood zone. You're in an X zone, which is a voluntary zone. And one of the things I've taught real estate agents over the years is don't confuse flood maps with common sense. Okay?
It's hard for me, Mike.
Okay. So, for example, around the Lafayette River in Norfolk, a lot of the houses that are on the water are not in a high-risk flood zone because when those houses were built 100 years ago, they were smart enough to elevate the grade, and because of the height of the house, it's sitting high enough not to be in a high-risk flood zone. But the houses across the street that aren't on the water, they're much lower, and they are in a high-risk flood zone. And you don't have to be close to water to be in a high-risk flood zone. There are low-lying areas throughout Hampton Roads in which houses that are miles away from a body of water are still considered high-risk properties.
Well, I guess you didn't answer my question.
I'll get back to that.
All right, good. Because on the map, I'm an evacuation zone.
Okay.
I know I'm in a flood zone. Everybody in this area is in a flood zone, but I'm on an evacuation zone, but it's only like a portion of my front yard, according to the map. And it means basically that I have to absent myself from the house if they call for an evacuation. And the guy across the street is right on the water. He's not on the evacuation zone.
Well, the whole evacuation zone is a little bit confusing because some of the letters that they use to classify evacuation zones are some of the letters that identify high-risk flood zones. And so when you have an evacuation zone, that means you are supposed to leave first. And the whole concept of having evacuation zones is so that we all don't get blocked in the tunnel all at the same time or on the bridge. So if we leave in groups instead of all at once, then it's supposed to help us navigate through a bridge or a tunnel or whatever we need to get out of the area. So when you have an evacuation zone A, you're first to leave, B, you're second, C, you're third, and so forth.
Okay, I have a question for you. We were talking about a little bit earlier, we were talking about the transference of insurance. So if I own a home and I sell it, can I transfer that insurance at the rate it is today to the new buyer?
Sometimes all the stars have to align to transfer a policy. It's still, the National Flood Insurance Program still allows transfers. Okay. However, for example, if you are a USAA member and your flood insurance is through USAA and the buyer is not a USAA member, then USAA will not allow the transfer of that policy. Sometimes mortgage companies have hiccups with transfers, etc. But in today's market, if the person who is selling the house has a policy that is rated with the previous rating system 1.0, you're going to want to get a quote with 2.0 before you decide as a buyer whether to take that policy as a transfer. And it's for a couple of reasons. One, the 1.0 rating may be much less than the 2.0. So once you renew, even though you had the transfer, once that transfer renews, you're going to go to 2.0. So you want to know what that rate is in advance. You may get a year's of premium relief, but you're ultimately going to land on 2.0. The other thing is 2.0 may be less expensive. Mm-hmm. I had that happen today, where a premium was literally $3,800 a year with 1.0, but with 2.0, it came in at $891. So if that's the case, you're not going to want to transfer.
Right.
So you need to make sure that, A, you can transfer it, that the bank is going to allow you to transfer it, and you want to make sure you get a quote on 2.0 so you can make an educated decision.
Okay, just one more question to follow up on that. So I'm going to assume I'm at high risk if I'm at the oceanfront. I'm at high risk there, and I'm going to be paying a premium for my insurance. Is that right?
That's not right.
Okay.
Okay. So, for example, once you get to 39th Street in Atlantic and go north all the way to 89th Street on the ocean side, there's not one single house in a high-risk flood zone. However, once you get to 64th Street and those houses on the land side back up to the park, the ones that are closest to the park may well be in a high-risk flood zone.
Why is that?
Well, the length of the beach at the north end has a lot to do with it, the height of the sand dunes, and those houses are much higher than the ones out back towards the park. The park, a lot, when it rains hard, that park floods and the water comes towards the houses from the park.
I have to ask you, if there's I know it's not a rumor, I know it exists, but there's the fabled Pungo Ridge. Doesn't that come down and have a significant impact on these ratings all the way down the ocean front into Pungo itself?
I don't know that the ridge itself is the cause for flood insurance premiums to be what they are. That is a very unique area, just like Poquoson and just like Larchmont. There are pockets around Hampton Roads that it can be a perfectly sunny day, and it happens to be high tide and a full moon, and the wind's blowing in a certain direction, and those areas are going to flood without a drop of rain. And Pungo is one of those areas that happens. If the wind is coming from the southwest, it drives the water from Back Bay up into that ridge, and those areas are very, very low, and they do flood. So there's been a lot going on, too, with how the city has built down there, and the drainage systems for certain neighborhoods were not properly designed, and those neighborhoods are having trouble with flooding.
Okay. Now, I have a house, and I'm not going to use mine because I'm not going to take the steps, but somebody wants to lessen the impact of flood insurance on his house. And one of the things that you offer are classes and design and execution of mitigating procedures. Describe that. When you talk about mitigating a flood, you tell the term.
Okay.
You're better at it.
Flood mitigation is when you try to reduce the consequences, the negative consequences of a flood event, both on life, on finances, and on property. So a lot of older homes that were built before the flood maps were drawn, which they were drawn in most of Hampton Roads in 1975, houses that were built before 1975 are not as compliant as newer homes with today's flood codes. And because they're not as compliant, they're not as flood resistant, which means they're a higher risk. So their premiums can be substantially higher. So flood mitigation, part of that is designing how to bring those homes into compliance with today's flood codes. And my little joke is I sat down one day and figured out how to make FEMA code, flood insurance code, and building code all dance together. So over the last 10 years, we've designed over 1,500 mitigation projects, both for residential and commercial. What we're currently studying is, while we knew for a fact that we could often reduce premiums by 85 or 90%, which is very important to debt-to-income ratios, what we're studying with the new 2.0 is exactly what impact does not only flood mitigation have on flood insurance premiums, but the value of what we call elevation certificates as well.
Let me ask one quick question to put it in perspective. What is, in your estimation, an average cost of flood insurance in this area for affected properties? Just an average.
The average premium in Hampton Roads is one of the highest in the nation. It's about $900 per policy.
And that is scheduled to change under FEMA 2.0. Is that correct? By how much?
What FEMA was saying in their marketing materials leading up to 2.0 is that 80% of the households would feel an increase or a decrease in the neighborhood of $10 a month. I'm not real satisfied with that answer now that the program has been in effect for almost 6 months. I'm seeing drastically different prices depending on where the house is located and what type of structure. So, for example, all of you out there with basements full of mechanical that have been paying thousands of dollars a year for flood insurance, with 2.0, when you renew, and there are methods to renew sooner, you're going to see 90% decreases for the most part. We had one not too long ago that was paying $4,200 a year. Their new premium is going to be $550. I also have some high-risk properties on oceanfront that are actually on the oceanfront itself, like in Sandbridge, Duck, Wilmington, North Carolina, that are also going to see significant decreases. These decreases don't make sense and most of us in the business are wondering how long those prices are going to last, but they're having a great impact on real estate transactions.
Well, Mike, didn't the feds actually want to increase the broader numbers of voluntary coverages, increase that to spread the risk?
Yeah, it has been a policy of FEMA for years to try to expand the number of people who have voluntary policies. In other words, not required to have them because they're in a low-risk area. And the concept with insurance is that the more people you have in the pool, it spreads the risk. And so now all of us are confused because many of the rates for voluntary policies are coming in much higher than they were under the previous 1.0.
Differentiate for me, and we should have a homeowners insurance agent in here too, but your flood policies do not cover damages from wind and rain that accompany a hurricane. And isn't it true that a significant amount of the damage to homes, especially inland homes, is from that, not from flooding?
Yeah, I am a homeowner's insurance guy. I just don't do it very often, so I'm not very good at it. But anyway, homeowner's insurance and flood insurance does not overlap at any point, any intersection whatsoever. So if, for example, your car was caught in the street and it flooded, that's auto insurance, okay? If you have a pipe burst in your house and it floods the first floor, that's a homeowner's claim. So the definition of a flood, the easiest definition is if you have water flood two properties simultaneously through rain or mud or water flow, then that's considered a flood. And so one of the things that has gone on in various hurricanes, especially Katrina and Sandy, is there have been many, many lawsuits on what caused the initial damage to the structure. Was it wind and hail, which is homeowners, or was it flooding? And so hopefully my hope is that within the next 5 to 10 years, through the private sector, there may be policies that will cover both.
But now, isn't there a specific rider that you have to attach to a homeowner's policy to cover wind and rain damage?
In North Carolina.
Just in North Carolina?
Yeah.
Joyce, do you have another question?
You know, I want to talk about new construction. Is there anything that you can do when you're building a new home that would minimize the risks of flooding, number one, or also help you to minimize the insurance costs, the flood insurance costs that are associated with it?
So every city in Hampton Roads participates in what's called the Community Rating System. Okay. We call it the CRS program. The CRS program is a FEMA administrated program that is meant to make entire communities more resistant to flooding, safer, less population displacement, quicker economic recovery. And there's a lot to it. It's a huge program, and the cities have to put a lot of resources towards it in order to score well. So as the city scores well, they score in 5% increments from 0 up to 45%. The closer what that number represents is the discount that everybody in that community gets on flood insurance. So the city of Norfolk, for example, just moved up to 25%. The city of Virginia Beach, I think, is at 15%. Yorktown is at 20%. All those people in those communities are getting discounts based on those cities' performance in the CRS program. Now, the CRS program, part of that is building code. So, and the way FEMA manages that from afar is through the Inspection and Permitting Office. So if the cities are issuing permits and inspections that aren't FEMA compliant, they get dinged on their CRS score, and everybody in the community has to pay more in flood insurance. The irony with 2.0 that everybody needs to know is builders and people who are doing major remodels still have to make their homes compliant with FEMA flood code. We're just finding there's not as much financial incentive as far as premium discounts are concerned with 2.0 as there was with 1.0.
Okay, Mike, I want you to give the folks your name, your company's name, and the phone number and email address where they can reach you and reach out to you and get answers and perhaps generate business for you.
Well, thank you very much. The name of the company is Flood Insurance, Hampton Roads. My name again is Michael Vernon. My phone number is 757-636-6455. And the Virginia pilot started calling me the Flood Fixer. So my email is mike@thefloodfixer.com.
Mike, we really thank you very much for being here. As you regular listeners know, Joyce and I hope you enjoy our broadcast. We do it so that we can generate business, of course, and demonstrate that we have a grasp of the market and a grasp of the processes of buying and selling homes. And if you are interested in a subject that we haven't covered over the past 11 weeks, please contact us at either fuquahomesales.com or carcaisehomesales.com or on Facebook, Fuqua Home Sales, Carcaise Home Sales, or you can call us at 757-449-7463 or Joyce?
757-324-2445.
Buying and selling homes, especially in this market, can be stressful. We've just spent almost 30 minutes on flood insurance. Mm-hmm. We spent almost 30 minutes on the loan packages that are out there and what's transpiring. And all that creates difficulties for people in grasping what they're undertaking to both sell a house and to buy a house. And when you're in the market to sell your house, you have to be cognizant of what's happening with the buyers, what their worries are. Just as we will tell you, it can't smell like dead cat. It's got to be a well-conditioned house in order to generate the highest price. And we are going to offer you, for listening to us, what are we offering these folks?
Okay. So we're going to offer you a free copy. We have a digital copy of 31 Tips to Sell Your Home, and it highlights the proven strategies on what it takes to actually sell your home at a premium price.
And it works.
It does. It does.
I've been doing this for 25 years, and I've been very fortunate. I have great clients who listen, and if they don't listen, they're not great clients. And so far, I'm batting about 99.99%. And the key thing is you have to realize that when you're selling a house, you're selling the sizzle, not the steak. You're selling the sizzle. When people walk in, there's got to be a wow factor or something that makes about your house that makes people take a step back and say, I could make this my home. I could really enjoy this, and I've got to figure out where am I going to put the Christmas tree. Can you elaborate on that at all, Joyce? Am I putting you on the spot?
No, it's the same thing. It's also when you walk in, knowing that you visualize where your furniture is, you visualize your photographs up on the wall, you visualize your memories that you can create there. So I think that's really important. And like I said, there's a lot of steps that go into that, especially with staging. And that's one of the key things that we help with as well. What to keep, what not to keep.
The other thing is, and coming from a graphics background as I did, the images that your house is projected in, or the images that we use and create to sell your house go national, in fact, international. And so it's very important that there be professional photography. We're using 3D photography. We're offering floor plans, drone shots, aerial shots. We want to be certain that the buying public out there who goes on a website to look for a house sees yours in the best possible light. I reviewed one today that is a $29 million property. And I will tell you this. I've seen a lot of presentations. This $29 million property has about $10,000 worth of photography, and it's not as good as what we do. And it's a shame because the focus is not on the living capability that the house offers, but on the design. And people don't buy design. They buy neighborhood and feel. It's an emotional decision.
That's right.
We're getting close to running out of time. Joyce, let's do the rejoinder. Tell people how to reach us once again, and then we'll say goodnight. And our special guest next week is a surprise.
Yep, it's a surprise. It's going to even be a surprise to us, frankly. So this is the Real Estate PB&J Hour with Joyce Carcaise and Paul Fuqua. come visit us again next week on Money Talk 1310 AM, 100.9 FM, and we look forward to having you back. Thanks for
YouTube.
listening.
Go to YouTube. The Real Estate PB&J Hour.
Yeah,
We're all
we've
there.
got our archives all up there. Take
Bye-bye.
a listen. Bye-bye.